guest joining us in our studio, Sunil Singhania, CIO Equity Investment at Reliance Mutual Fund, joins us. Sunil, good morning. Good to have you in our studio. First up, let me congratulate you. You've been chosen the best fund manager.
Thank you for your
Must be a
wishes.
special feeling.
I think it's the faith of our investors and all the hard work done by my colleagues. I think I'm the face of it. But all accolades are welcome in this challenging time. So thanks a lot for the wishes.
Okay, so let's talk about the market now. What is this telling you, this big rally that we are seeing today? Are we reading too much into this, or is this the market's way of saying that, okay, we are giving a bit of a salute to the budget right now?
So yes, we are seeing a big rally today. There is no doubt about it. We can see it on the ticker. But I think what has happened is that in the run-up to the budget, one, there were a lot of sort of negatives which were being talked about. So the market was bracing for a more challenging budget, specifically on the capital gain side, on the equity market taxation point of view. And I think to that extent, the budget has allayed those fears. So there are definitely some additional taxes, specifically on the so-called super rich, whether it's the dividend tax or the crorepati tax, or the cess on motor cars and so on and so forth. But the increase in expenditure, along with the fiscal consolidation map which has been maintained, I think that has given a lot of sort of hope and optimism as far as the market are concerned. We also have to look at it in the light that the global markets are sort of also consolidating. So that is also helping sentiments. So I think it's a combination of both stability in the global markets as well as so-called big negatives not coming out. And to that extent, a positive surprise being sprung up,
Okay, by the way, that's Eicher Motors sales numbers looking extremely good right now, 63% higher. So the total Royal Enfield sales have gone up by 63% to 49,150. Eicher Motors, of course, is a stock that corrected a lot, but from the lows, it's seen quite a bit of rally. In fact, if you see the 306-month chart of Eicher Motors, that's where we have seen a big rally. Sunil, we'll discuss some market questions in a bit. Your thoughts on this EPF tax, both in terms of the employer part being locked till 58 and the employee part being taxed now. Do you think this is draconian, and do you expect this will be rolled back?
I think as an interested party and being one who will be majorly impacted, I think this is definitely a negative. If you actually see in India, the most honest taxpayers are the salaried employees, because frankly they have no choice. And all our expenses are after taxes. So, our mobile phone bills, education, house rent, or even, the society charges are all after we pay income tax. And on that of it, if your retirement is also going to be taxed, I think it's a little bit unfair. But hopefully, maybe it's a slip. And there will be some clarification, so let's hope for the best.
Yes, fingers crossed on that. But coming back to the markets, what's also got the markets very excited is the possibility or hope that the Reserve Bank of India is going to oblige and reward this fiscal prudence with a rate cut. A, do you expect an out-of-turn rate cut? If yes, what would be the quantum of that? And last time around, we topped out when the Reserve Bank of India gave us a rate cut post the budget. What will happen this time?
So I think very clearly we expect a rate cut maybe in April. We don't expect a rate cut in the next 2-3 days. Obviously the RBI also would like to look at the budget in great detail and then react. We also expect another rate cut maybe post monsoon, and as is expected, we also expect the monsoon to be hopefully normal, and maybe we can expect one more rate cut before the end of the year. Whether the rate cut will be positive or negative, we'll have to wait. But our view is that we are reaching a scenario where now incremental good news is going to have a much more positive impact in the market than earlier, because from a situation where we were very optimistic, we are now in a situation where everyone is a little bit you can say not as optimist or maybe even pessimist about the market. So I think that is the reason why every small positive is now going to have a much bigger impact on the upside as far as markets are concerned.
Okay, we have Maruti sales numbers also flashing on your screen. So domestic sales have gone up a bit, 0.2%, but exports have fallen, and the net result is that the total sales are down about 1%. Of course, it's corrected so much right now. the Maruti stock is in no mood to react to that. In fact, the stock is gaining ground as we speak, up about 5%.
This is actually very disappointing, because if you see the YTD performance of Maruti's total sales, it's gone up by nearly 10%. So that would have been the average monthly run rate, and that's fallen off the cliff in this month, because the total sales have declined by 0.9% versus a YTD growth of nearly 10.1%.
Oh yes, this is disappointing, but there's a loss of 10,000 units due to that agitation that took place in Haryana as well, so keep that at the back of your mind. Sunil, the big question then, this hasn't been a good year for portfolio investors. Everyone is scared. We've been talking about bear market. Do you think the environment changes now with this budget, or do we need to see more evidence from global markets, fund flows, before you start to build portfolios constructively?
So, one thing is that every equity investor has to be an optimist. So unless you're an optimist, you should not be an equity investor. And we are actually optimists from an economy, from a medium to longer term perspective. There is no second doubts about it. Yes, we have seen challenges like never before in the last 1 year, both coming from global market as well as domestic markets. However, as we move forward, I think there are a lot of positives which can surprise us. Obviously we talked about the rate cut. There are positives which can come up from the policy front. Maybe the GST and the bankruptcy code gets passed. Maybe the monsoon is good. The global markets are anyway sort of stabilizing. We have seen a few global emerging markets like Brazil and Indonesia move up sharply from their lows. Currencies are stabilizing. Oil is started to stabilize around $35 and moving up a little bit, which should give a little bit of support to oil producing countries. So I think everywhere we are seeing a little bit of stability emerging. What we need for the markets to sustainably move up, obviously, is earnings. And the earnings have not been coming over the last 2-3 quarters. So I think that is one thing which we would track very closely before we become very positive in the very near term.
Okay, so on that subject, Sunil, you've summed up the budget as fiscal prudence over expansionism. The capex increase is a paltry 3.9%. Do you think that the budget has done enough to improve the demand and increase the corporate earnings? And when do you expect that corporate recovery to come through?
See, if you actually go in the detail, you are right that the capex plan is only 4%. But if you actually break up, the revenue estimates are also pretty modest on the tech side. Yes, on the non-tech side, they look a little bit optimistic, but on the tech side, they are relatively modest at 9-10%. We also have to bear in mind the fact that the central government has been allocating more of its resources to the state government. So obviously, they expect the state governments to reuse those resources for capex rather than they doing it. Third is, on the sectors which the central government is concerned about, which is rail and road, the capex has gone up quite meaningfully. So I think we expect the central government to focus on the sectors where the central government is, basically supposed to spend, and more of the capex shifting to the state governments. So I think we should not read too much into it. But obviously, the headline number, instead of 4%, if it would be 8%, it would have looked better. But I think these are budget estimates. As we move forward, there will be some disappointment, some positive surprises, and we'll have to see how it pans out.
Do you think the auto sector or the car sector will take this cess in its stride and move on, or do you see a bit of an impact on monthly sales because of that, and maybe a bit of a derating, not much, but bit of derating in the auto space?
See, in the near term, obviously, it takes time for it to be fully passed on. However, actually, if you see, as I mentioned earlier, this is an attempt to, sort of have an extra tax burden on the so-called super rich. So instead of 10 lakh rupees, if your car starts to cost 10,000, well, you defer your decision. I think that is something which we have to, wonder about. The other thing is, if there is a slight reduction in interest rate, then maybe your EMI, even with this 1 or 2% extra that you have to pay, might not go up substantially, So we don't expect it to cause too much of a concern as far as demand is concerned, only because of this additional cess.
Okay, the other big issue that we need to discuss is this whole PSU bank recapitalization. 25,000 crore, the market's expectation was clearly much more than that. But leaving that aside, what's your own call on PSU banks? Valuation-wise, they look so good, but we don't know what could be the next NPA issue. How would you approach the sector now?
So very clearly, PSU banks are undergoing stress. There is no doubt about it. And we don't know how much money they will need for capitalization. One positive thing is that the finance minister has clearly said that if need be, they would provide more capital. We have a Gyan Sangam coming up in the next 3-4 days. I think that would be more worth pursuing and tracking than the budget itself, because that is where the direction towards the future of the PSU banks per se would be more clear. You know, whether there will be more consolidation, which is what the finance minister has clearly said, how much capitalization they would need. From our perspective, we believe that the smaller PSU banks are going to face increasing challenging times as we move forward. And therefore, our view is that, you know, right now, some of the corporate private banks have also fallen in line. And maybe at this point of time, they are better bets than some of the smaller public sector banks. You know.
What's the broader Nifty call now? The budget is done. We've got a sense of how the corporate earnings are likely to pan out. Say by the end of the year, how much higher do you think the Nifty could go? And do you think we've already put a bottom in place closer to the 6,800 mark, or do you see another down move coming?
So very clearly, we do believe that we have seen the bottom. However, the pace of the upside is going to be dependent on the earnings growth. Earnings growth have been absent last 2 years. Last 2 years, we have seen almost flat earnings. So the EPS which was there in FY14 is the same as FY16. And that is the reason why the Nifty is also almost at the same levels. So we have to see the growth in earnings.
March but that's earnings, not likely to come through anytime soon.
March earnings might not come in, but maybe, you know, June quarter onwards, you will start to see a few sector spring surprises. So, you know, this quarter, for example, the impact of the MIP on steel is playing out beautifully. You know, the prices have gone up by 5,000-6,000 rupees a ton. Maybe the steel companies might spring a surprise in the June quarter. Banks have been providing very aggressively. You know, 1 or 2 more asset sales, the way we have seen a large cement asset sale of almost 20,000 crores happen. If that comes into play, then maybe the banks might not look as bad. So it's a very fluid situation. Let's see. Yeah.
Okay. Sunil, you know, be candid about this. You know, since you had such a big mutual fund, what is happening in terms of retail fund flows? I want to know about 2 issues. One, on SIPs, have we seen slowdown of that? And 2, have we started to see any kind of redemption pressure?
So SIPs are going on the way they have been going on for the last 15-18 months. The SIP book is roughly 2,500 crores to 3,000 crores, but the lump sum has slowed down. Okay. So, you know, from a run rate of almost 3,500 crores lump sum every month, so a total of almost 6,500 crores, the net inflows have slowed down to around 3,500 crores. But even as we speak, this month we'll also see net inflows. And I think that is being reflected in the net figures which you see every day.
No, but that's a bit of a slowdown. So is that a concern? And the other concern is there a risk of this flow turning into negative if the market hits another low and, you know, we keep making these, you know, lows every 3 or 4 months?
So one is we don't expect the market to hit. The second is, you know, I'll give you a perspective. You know, we've been managing money for so long, and normally when the markets have such a deep correction, investors are very concerned, and you end up doing a lot of road shows and a lot of calls. This time I think the investors have been very prudent in their investment style. So except maybe the HNI category, which has put in a lot of money, the retail has been only focusing on the SIPs. And there the losses have not been all that big to cause a worry. So, you know, 1 year returns per se have been like negative 10% to 20% for the funds. But SIP investors maybe are down 5-6%, you know. So there is still hope, and we are also pretty optimistic. Let's see, if the returns don't come for the next 1.5 years, then maybe you might see some pressure. But at this point of time, I think investors are continuing with their SIPs and are quite optimistic.
I was seeing the portfolio of one of your largest equity funds, that's Reliance Growth Fund, and it seems to have a bit of a bias towards defensive plays. For example, IT names like HCL Tech, Infosys has a weightage of close to about 10%. Pharma names like Cipla, Divi's, have a weightage of close to about 7-8%. Do you think you will continue with this IT pharma or defensive play, or do you think it's time to up the beta considering the fall that we've seen?
So one is, we maintain the portfolios based on the, the fund philosophy, and we are very clear we'll have portfolios which are diversified. At the same time, the sectors which you mentioned are good sectors because one, they are growing. So even IT is growing at, in rupee terms, between 10 to 15%. Pharma is growing much faster. And they also benefit from a slightly weak rupee which we are seeing. and it adds a lot of stability to the overall portfolio. So if you go down, we have a lot of economy related stocks also. So we have good exposure to private sector banks, we have good exposure to niche financials, even capex companies, and I think we will maintain that characteristic of the portfolio.
Will you look to add any budget plays to your portfolio? If yes, which would be the sectors where you could look to enhance your allocation?
Frankly, your long-term investment cannot be based on what the budget has done in the near term. Yes, there will be some sectors which might incrementally get some benefit because of the budget, and some which might get incrementally, sort of negative. But I don't think the budget has been something which will cause us to increase exposure to a sector by 5% or reduce an exposure to by 5%.
Okay, Sunil, final question then. You said that you hope that the market has made a bottom, but from here on, do you think equities would beat the rest of the asset classes in terms of returns over the next 2 or 3 years? Are you pretty sure about that?
So frankly, we have been wrong last 1.5 to 2 years. We definitely believed equity will do better than gold, but gold has gone up by 25%.
1 or 2 year aberration could always happen.
But see, if you believe that the economy is going to grow, which we definitely believe, and we are very clear that the equity from 2 trillion is going to be 4 trillion, there is no way where equity can underperform any other asset class. So, very clearly, my overweight would be equity.
All right, Sunil, thanks a lot for talking to us, and we wish you keep making money for your investors. Thank you for joining us. So that's the view from Reliance Mutual Fund, bullish on the market from this point. We'll do one thing, we'll take a break. Once we come back, we'll